pleased to introduce two of our team members. We have Carolee Rogers, who's the the Manager of Business Services and Tax with Strategic, and Pravesh Daya. Oh, there you are. Yeah. Sorry, they're not long distance classes.
I'm easily missed.
Pravesh, who is a private client advisor with Morgans, and they're just going to give a bit of an update, see how any changes that are coming through now, what they might mean to you. So I'll hand over firstly to Carolee.
Yes, I'm sure everyone's relieved, no matter which way you voted, that the election's over. So I won't go too much into details following budget and budget announcements and things like that. Just a little bit of a brief overview of, what it means now that we have the coalition in power, and what was suggested in budget night back in April. What's coming to fruition and whatnot, and then I'll go into different categories of individuals, business, whether you're in business or into super, as far as changes in the budget and for tax planning, because we're in June, so no doubt you're all busy with your planning towards the end of June. At Strategic, we wholly look after all various services through to your obvious tax, lodging your tax returns, preparing financial statements and the like to keep you compliant if you've got trusts or just individually, right through to offering other extended services. We do a lot of business restructuring. We offer virtual CFO services. We appreciate a lot of our clients who might be in business or professionals. You're always busy trying to run your business or maintain your work life, that you don't always have time to think about your accounting and your bookkeeping and your financial side of your life. And that's where we step in and help you, stay focused on your financial goals and keep you on track and work with you, particularly in family businesses where you might have mixed family in a business. Sometimes there's a little bit of to and fro which direction business might want to go, so we can be that third spoke in the wheel to help keep things on track. And it works quite well to allow people to keep running their business and do what they do well, and help us guide them on their financial way. So now the coalition's in power. As individuals, back on budget night, ScoMo announced various initiatives. He's offering immediate tax relief for lower middle income earners. So as a single person, there's an additional $1,080 each year, or dual income will be over your $3,000 or $2,000. Sorry. There's personal changes to income tax rates which were announced but will likely follow through now for the next 3 years at least. There's more proposed for 2024. That'll have to wait, I guess, until the next election. There was a lot of scaremongering from the other side, from Labor, with respect to negative gearing going, which was quite scary considering the number of us that might have rental properties, and how much getting the benefit in your tax return of the negative gearing helps afford the low rents that we can charge our tenants. No changes to capital gains tax. The scare of losing the discount definitely was something, hampering the market. I know real estate agents and the like, straight after the election weekend, for houses that had been sitting on on their books for sale, had a lot of interest straight after the election. So I think, the discount on capital gains was a big thing, scaring a lot of people who, work hard to save and invest in property or in shares or anything else. Again, franking credits, whether you're, in accumulation mode in your super fund and you have self-managed fund or whether you're retiring. Excess, the likelihood of losing your franking credit refunds or a low income tax earner, individual, could make a significant difference in your cash flow during the year if they were to go. So it was a relief that they have stayed with the not having a change in government. And a few other initiatives that are coming through for first home owners, which, let's face it, with property prices on the, around the country, to get into the homeowners market, they need every little bit they can get. Business owners, there's an unlikely cause of any significant rise in the minimum wage or changes to penalty rates. The extension to the instant asset write-off, which I'll go into a bit more detail, has been extended. There's been tax cuts that will stay in place that were, forecast and proposed for companies that will stay, and there'll be no tax on trusts. That was scaremongering, I guess, from Labor, where trusts were going to be taxed like companies at 30% or similar. And other initiatives that are being put into place. There's a $2 billion business securitisation fund to help regional banks and smaller lenders offer more competitive interest rates to their borrowers, and I guess to deposit holders as well, offer a higher rate, and various other initiatives coming through. For retirees, they're finally helping us get money into super for a bit longer, acknowledging that, people are working longer, saving longer, but once you hit age 65, all the rules start to change as to how easily you can get money into super. So they've increased the contribution age gap for spouse contributions. If you're helping your spouse even up the contributions in their fund. We've had a bring forward rule for the last few years where you can put money into super, bring forward a couple of years, so it's $100,000 a year, and you can bring that forward to $300,000 in any 1 year, meaning that you can't then for the next 2 years put money in. They've extended the age for doing that, because once you're age 65 and have trouble meeting the rules to put money in, they've increased that age from 65 to 67 from 1 July 2020, so it allows for a little bit of planning there. And they're gradually reducing the red tape for calculating pension benefits, which probably doesn't affect, if you've got your own self-managed fund, doesn't affect you so much, but it does help minimise, the administration cost and whatnot. And they're talking of scrapping the work test for those aged 65 and 66. So once you hit age 65 at the moment, you have to work a minimum of 40 hours in a 30-day period to be eligible to put any form of super into your fund. And so they're increasing that age gap a couple of years as well, whether it's voluntary contributions or ones to receive your tax deduction or employer. Okay, there's immediate changes coming through with some of the income tax rates for individuals. I guess moving forward, that there's only a little bit of time left for this financial year, but there's a lot of planning opportunities in the next few financial years for the fact that the top marginal rates are lowering, where you might have the ability to change dividend strategies if you've got your own company and pay wages and alter them. You can start to plan with your advisors, how you are remunerating yourselves to better benefit changing the tax brackets. So the rates as they stand at the moment, and for the next couple of years, you know, pretty much up to your $90,000 limit. You're not that much higher than a company. But of course, once you start earning a decent salary, you know, we're still getting slugged fairly heavily. It's proposed come 2022, 23, that middle, you know, income bracket there will really have some relief, and then hopefully this column, you know, it's in the mix, but I guess there's another election between now and then to whether this one can come through, but it would definitely improve, you know, the hard work that it takes to get into those income brackets worth the while. So there's, you know, as I said, there's some planning opportunities between now and here to, you know, if you've got the ability to manipulate your income a little bit through planning with your employer or through your own strategies in your business, to make some decent savings. So being June, I mean it's the 4th of June, we don't have a lot of time between the 30th until the 30th, but there are still some opportunities to save and tax planning opportunities. If you've got rental properties, investments of any kind, and you know you've got expenses coming up in the next couple of months or the next 2 months, you can bring them forward. You can prepay them as individual. You can prepay things and receive the tax deduction when it's paid. It's not when it's necessarily, if you've received it and it's not due for payment, I should say, until after June. If you pay it by the 30th, it's deduction now in this financial year. If you've got capital gains coming up, or you're in the process of negotiating contracts on property or anything like that, as long as it doesn't hamper the deal, you know, this close to the end of the financial year, to sign a contract on the 1st of July rather than before the end of June, will give you, if it's something you're going to make a substantial gain in and receive a hefty tax bill on, it definitely gives you a little bit longer for that tax bill to come due and to come to fruition if you were to delay signing the contract, because capital gains is assessed on when the contract's entered into, not when it settles. So it's this close to the end of the year, definitely an opportunity to, you know, defer paying the tax man for a little bit longer. It'd mean that tax wouldn't be payable until May 2020. 21, yeah, 21, thank you. Super. As individuals, there isn't a lot of opportunity to tax plan, other than some of the things I'm mentioning. Super's always a good one. If you're, you know, in that sort of middle bracket and your employer contributions aren't being maxed out, to do that little bit of a top up. Since the 1st of July last year, you're able to, you don't have to go through the arduous task of going through salary sacrifice and dealing with your employer's payroll department. You can, you know, put in a contribution directly to your fund yourself, and as long as you acknowledge to them that you want to claim a tax deduction for it, you know, you can top up and maximise your contributions and get a tax deduction for it. Also, if you're you know, supporting a low-income earning spouse because they're looking after the children or studying or something like that, you can top their super up as well. And receive a tax offset of up to 18%. So as long as you make a contribution of at least $3,000, and it's up to $100,000, but as long as you make a contribution of up to $3,000, you can get a $540 tax offset, which isn't a lot, but it's $540, and it does help to even up, you know, your spouse's contributions and super balances if someone's out of the workforce in a dual income family for a little while, as a lot of households are at some stage. Business. There's been a lot of changes with the changes in the company tax rates over the last few years, and it's been a big benefit to have the change in tax rate from the 30% down to the 28.5% down to the 27.5%. And not all companies are eligible for the lower company tax rate. So if your company is earning income from passive sources, so rent, interest, dividends, or if it's getting trust distributions or partnership distributions from that are derived from similar sources of income, if that source of income is greater than 80%, then they're not eligible for the lower income tax rate. If they've got to have at least 20% business income to meet that, to be eligible, they call it a base rate entity, and you have to have that level of income to meet the requirements for the lower income tax rate. So the benefit now is great, paying less tax, and that broadened up it's based on turnover as well. So to be eligible, it's not just a test on the type of income that the company's earning, it's also a test on the level of aggregated income. So aggregated whereby if you're in a group, they will look at how entities within a group are owned and whether they're to be grouped and aggregated together to work out the turnover test for this eligibility. So it was 25 million in 2018 to get you 27.5%. They have broadened that in this financial year to be 50 million, so broadening that threshold has captured a lot more family businesses or into the lower tax rate, and that's going to keep reducing down for the next couple of years. So while it produces a cash flow benefit now, it's good. There is some downfall though, which I'm not sure if you've got companies, if you've had any discussions with your advisors on that, particularly if you've been in business for a long time and you've accumulated your franking, which is where you to pay tax into your to the government, you get a credit into your franking account, which then is your imputation credits on your dividends when you pay money out to the shareholders. There is a catch where whilst you've been paying the 30%, you've been building up your franking at that level, but when you're now eligible for a lower company tax rate, your dividends coming out are also only eligible to be franked at that same lower company tax rate. So with time, that does mean that, I'm going ahead of my slides, I'm sorry, which basically means with time, you will have franking in your franking account that you just can't get out. So as an example, if you've earned $3 million in the years and your retained profits have accumulated over the years, you've been paying 30%, then with time, and you're paying out then dividends of 10 million, you end up with franking coming out of 825,000, while you might have franking in your balance account of 900,000. So you'll end up with 75,000 of franking credits that you'll never be able to get out. So I guess that's staying in the coffers of the government and the tax office. But I guess with the ability to still have franking credit refunds and whatnot, we can't be too upset that we've got some benefits there still coming through. So back to the base rate entity concept of whether you're eligible for the lower tax rate. Just an example, you can't split your income within your company and say some's passive and some's not passive and apply a different company rate. It's wholly dependent on that 80-20 rule. So, and a lot of people maybe in this room who might have investments going into corporate beneficiaries and having the bucket strategy where you exhaust beneficiaries receiving distributions to the company tax rate, and it's tax effective to bring a corporate in underneath to receive some distributions, where you've got a mix of distributions coming through, say from your passive sources like rent income, in this example, $100,000 rent income merged into another trust that might have a business running inside it with $300,000, all gets distributed to the company to maximise, minimise tax, maximise everyone within the family group receiving tax-effective income tax rates. Then this would meet the passive income test, because only a quarter of the income is passive. You're under that 80% rule, so they'd be eligible for the 27.5% income tax rate. It'd be, if the flow through coming through was any higher, of course it wouldn't come through, so you do have to look through where your distributions and income sources are if you're in that sort of structure where the company's receiving money from different sources. So year-end tax planning. You can have a little bit more flexibility in business as to whether you can defer your income or not, as opposed to an individual receiving a paycheck each month. So if you've got contracts coming up or invoicing to do towards the end of June, and maybe invoicing a week later will push it into another year, then it's an opportunity to maybe do that if it's something that works between you and your customers. Income in advance, if you're receiving rent in advance, or you're a builder or similar type of industry, and you're receiving a lot of deposits in advance, or progress payments, or deposits on contracts, if you haven't done the work yet, they're not taxable. So there's something to make sure that you're allocating in your books correctly, to make sure you're not being taxed or on something that you haven't done the work for yet. You don't have to include them in your assessable income in that year just because you received the cash. Trading stock, if you're running stock through your accounts, there are different ways to value your stock, and I don't know that too many people consider that too often. They just do a stock take and put it in, but it can definitely change the dollar value in your tax return and change the bottom line if you have a look at the different methods of revaluing your stock that you report at the end of the year. And similarly, like I said earlier, contracts of sale, you can push them out to early July as long as it doesn't hamper the deal, and push that sale into the next financial year. Expenses, housekeeping on your books. So often we have our clients are buying capital through the year, or spending on things that aren't necessarily deductible, legal fees, entertainment that's not outright deductible. And in their software package they can see their bottom line sitting at a certain level, and then we come along and have to clean things out that aren't deductible or that have to capitalise them, and certainly changes the picture on the tax position for the year. And post June 30 there's not a lot we can do about it once the clock's ticked over into 1 July. So always a good idea to run your eye over your books to see if there's any allocations there that need reallocating, and so there's no hidden surprises on your profit for the year. You can prepay expenses if you're a small business, and bring them forward. Larger businesses can't do that, so if your turnover is greater than 10 million, you can't claim on prepayments. However, if you're a small business, you can, so it helps bring them forward. If super is not deductible for employees if it's paid after the 30th of June, so if you're on a quarterly payment cycle for your employees' super, pay it by the 30th of June and you get a tax deduction in that year. If you pay it by the mid-month or end of the next month when it's legally due for payment, you don't get a deduction until the next financial year, so that's a good one. Particularly if you're used to paying it in the month after, it's a good once-off cash flow, tax benefit to bring that forward and get it in by the 30th of June. Have a think about your debts owing. Who owes you money? You can clean as long as you can foresee that you'll never get the money, it's always a good idea to run your eyes over your debtors and do a bit of a clean up to reduce your income. Is your asset register up to date? If you've got a lot of obsolete old items on there that have been scrapped, replaced, it's not too often people sit down and run their eyes over the depreciation schedule. It can be a good way to get some write-offs of equipment that you haven't used for a long time, already gone to the scrap heap or what have you. Cleans up your books as well as gets you a bit of a deduction. Logbooks for motor vehicles. So often, you know, we have clients doing high mileage, but if you haven't kept a logbook, you're limited to 5,000 kilometres cents per kilometre at 66 cents, which is only a $3,000 claim. If you've got finance on a vehicle and depreciation and the like and a high business use of your vehicle, the deduction can be quite substantial. You know, the little effort of keeping a logbook for 12 weeks every 4 or 5 years can definitely help, you know, your tax position for you and your staff using motor vehicles. If you've got any new capital in need of capital equipment, the instant asset write-off's been extended, so it's a bit of a messy year of you know, applying the rules for the instant asset write-off, because we've had an announcement when budget night was made on the 2nd of April that the limit's going to 30,000. So in this 19 financial year, we've got 3 thresholds that we've got to consider as to when, you know, clients have purchased assets. Being June, if you've got any, because there's no guarantee, you know, these are going through till 2020, and we have each budget night got an extension the last few years. It's not guaranteed we'll keep getting them, so it's definitely some planning opportunity now until the 30th of June next year if you need some equipment. I guess the big thing with that is that's the GST exclusive amount, but also if you know you're buying expensive pieces of equipment. I know I had a truck driver once buy a dolly, which is like a trailer, but then you can't use that without something else, and the 2 items went over the threshold, even though separate invoices and everything else. If you can't use one without the other, it's considered one piece of equipment, so just be careful of that. It is per item, and it has to be installed ready for use. So unfortunately it's not something that you can prepay and bring forward an invoice into 30 June this year. If the goods haven't been delivered and they're not installed and you're using them, you can't claim it you know, under these rules until it's installed ready for use. Another opportunity, if you're self-employed, is the accrual of directors' fees and employee bonuses and similar employee costs. So a business can accrue something like a creditor and receive a tax deduction for it before the end of June. Employees don't have to, and as long as you pay it after June, the employee doesn't get taxed on it until the next financial year. So it's quite a useful tool if you're self-employed to move a little bit of income from one year to the next in your own family group by doing some careful planning around directors' fees and employee bonuses and the like. Also, if you've got company loans within your structure that you're managing repayments on and the like, one way of managing loan payments with companies is by paying an annual dividend. Such company loans also attract interest, so the company's paying tax on the interest, which can be quite hefty if the loans are high. So paying your dividend on the 1st of July rather than on the 30th of June can substantially reduce that interest. So that's something to plan for 1 July this coming year if you've got company loans coming through your balance sheets. Another one, just briefly, if you're an employer, I'm not sure if you're familiar with single touch payroll. employers with greater than 20 employees have been managing single touch payroll for the last financial year. So where this is a reporting mechanism where every time there's a pay run, the tax office is made aware of it. So it's an automatic reporting system from employers to the tax office straight away of pays being made to employees, and it's a way of the tax office tracking PAYG withholding obligations, super obligations, and the like for employees. So from the 1st of July, if you've got less than 20 employees, everyone's captured in the system. So it was a little bit of a transitional time to give smaller businesses time to get their software up and running and whatnot to be ready, but it's coming the 1st of July. So your software provider hasn't, given you the information on how to upgrade your software by the 1st of July. It's time to start asking some questions to get you compliant. Super. How am I going for time? Just about up? Okay. Sorry. So super, as I mentioned, coming up to the 30th of June, time to start planning for your tax deductible contributions. But there's also a lot of opportunity that you can go through with your advisors in respect to rebalancing your super balances within your family group, whether it's contributions going in that you're getting deductions for along the way, or if they're voluntary contributions. There's a lot of bring forward rules, even with the deductible contributions or your concessional contributions now that can be brought forward. So if you don't use your $25,000 cap from July 2020, they're going to allow you to carry that forward, which is a great planning mechanism if you know one year you don't use it all and you've got a big tax bill coming up with the sale of property or something like that. You can help balance out your tax planning through bringing forward some super deductions. I won't run through that. I won't steal any more of Pravesh's time, I'm sorry. And similarly, with your non-concessionals, for your voluntary contributions, they're capped at $100,000 each year, and there's a bring forward rule as long as you're under 65 at the moment, and it's going up to 67. You can bring forward that $100,000 and make a $300,000 payment, which exempts you then for the next couple of years on contributing. You're also restricted if you're already at your $1.6 million cap. So super's not getting any less complicated. So, but with the changes coming through, there's a lot of opportunity for planning of rebalancing your super with your partners if you're in a dual income situation or family situation, which working with your advisors you can maximise the best you can. So anyway, thank you. Sorry for going over. Okay.